Snap Inc. is currently trading at exactly $7.62 USD, showing a marginal intraday gain of 0.13%, or roughly 1 cent, in today's shortened Black Friday trading session. While the broader markets are relatively quiet, digesting the post-Thanksgiving retail data, Snap is sitting in a precarious but fascinating consolidation zone. Most investors glancing at this ticker see a stagnant stock hovering near its 52-week lows, assuming the company is slowly bleeding out in the shadow of giants. That is the expectation, that Snap is a dead money trade, a relic of the mid-2010s that lost the war to TikTok and Instagram. But the reality, the data sitting just beneath this flat price action, tells a story of aggressive internal restructuring, a quiet but massive pivot in advertising technology, and a user base that is far more sticky than the social media fatigue narrative suggests. If you are looking at this chart and seeing boredom, you aren't looking closely enough at the institutional accumulation happening at these levels. Let's analyze the immediate price action we are seeing right now. The stock opened this morning at $7.63, touched a high of $7.74, and has since retraced to this $7.62 level. This tightening range is classic accumulation behavior. You have sellers exhausted from the year-long downtrend, and you have buyers, smart money, stepping in every time it dips below $7.60. Compare this lethargy to the absolute fireworks we often see with Tesla stock, where a single tweet or a rumor about a battery update can send the valuation swinging 5% in an hour. Snap is behaving differently. It is coiled. The volume today is lighter than usual, expected for a half-day session, but the lack of selling pressure is the key signal here. When a stock stops going down on bad news or general apathy, it often signals that the weak hands have finally folded. If you were holding this stock hoping for a quick flip, you left months ago. Who is left? Long-term holders and contrarian institutions. When you log into your brokerage account, whether you are using Schwab Intelligent Portfolios for a hands-off approach or actively trading on the Interactive Brokers trading platform, you are constantly bombarded with the winner-takes-all narrative. You see NVIDIA stock breaking records, you see Apple stock remaining the safe haven, and you see Snap down here in the single digits. The psychological barrier of a stock trading under $10 often scares away the invest online crowd who equate low price with low quality. However, savvy investors know that market capitalization and enterprise value are what matter. Snap's current valuation is pricing in a near-total failure of their turnaround strategy. If that turnaround is even moderately successful, the repricing event could be violent to the upside. This is the tension between the market's expectation of obsolescence and the reality of a platform that still commands the attention of nearly 500 million daily active users. Let's talk about that utility versus social media distinction. Most people categorize Snap alongside Facebook or X, formerly Twitter. The expectation is that users go there to consume feed-based content. The reality is that for Gen Z and younger millennials, Snapchat is a utility. It is their primary mode of communication, replacing texting. You don't quit a utility the way you quit a social network. You might stop scrolling TikTok, but you won't stop messaging your best friends. This stickiness is what the bears are missing. While SoFi Invest users might be chasing the AI hype cycle, looking for the next semiconductor play, they are overlooking the data moat Snap has built. They have mapped the physical world through their AR technology in a way that even Apple hasn't fully capitalized on yet. In terms of the broader market context today, we are seeing a rotation. Capital is looking for value in a market that feels overextended at the top. If you utilize Fidelity Investments or their research tools, you might have noticed a subtle shift in sector rotation models. Money is moving out of the hyper-growth, high-multiple names and sniffing around turnaround plays. Snap fits this profile perfectly. It is a company that generates billions in revenue, has reached adjusted EBITDA profitability, yet trades at a multiple that suggests it's on the brink of bankruptcy. This disconnect is where the opportunity lies. If you are engaging in self-investing, you have to ask yourself, is the market efficient here, or is it traumatized by Snap's past earnings misses? This brings us to the advertising engine, the core of the bear case. For years, Snap's ad platform was considered experimental by big brands. It was for brand awareness, not hard conversions. The expectation is that advertisers have fled to TikTok. The reality, revealed in their recent Q3 2024 performance, is that Snap has fundamentally rebuilt their ad server to focus on direct response, DR. They are now competing for the same bottom-of-the-funnel dollars that Google and Meta command. They introduced the 7.0 attribution window, improved pixel tracking, and launched Sponsored Snaps in the Chat tab, a controversial but potentially lucrative move. If you manage your own investment, you know that operational pivots take time to show up in the stock price. The 7.0 attribution change caused short-term pain as advertisers adjusted, but the data now suggests that return on ad spend on Snap is becoming competitive again. Let's pause for a second. Comment below how many shares of Snap you currently hold, or if you sold them all for a loss in 2022. I want to gauge the sentiment of the real retail holders here. Are you underwater, or are you buying this dip? Now consider the competitive landscape. The elephant in the room is always TikTok. The narrative is that TikTok ate Snap's lunch. While true for time spent consuming content, Snap's user growth, up 9% year-over-year in the recent quarter, proves they aren't bleeding users. They are growing. And let's look at the regulatory risk. If the U.S. government moves forward with a ban or forced sale of TikTok in 2025, where does that ad revenue go? It doesn't all go to Meta. A significant portion of that vertical video ad spend flows back to Snap. This is a massive unpriced call option embedded in the stock. If you are using Robinhood investments to speculate on legislative outcomes, Snap is effectively a hedge against TikTok's dominance. Speaking of Robinhood, let's look at the retail sentiment on that platform. Robinhood stock trading data often shows Snap as a top holding among younger investors, but the conviction has waned. We are seeing capitulation in the retail data, small accounts selling out at the bottom. Conversely, if you look at Interactive Broker stock trading data, which skews towards more sophisticated or professional traders, we are seeing a slight uptick in net long positions and options activity betting on a rebound. This divergence between the retail crowd giving up and the smart money starting to nibble is a classic bottoming signal. It doesn't mean the stock rockets to $20 tomorrow, but it means the downside is likely limited because the sellers have run out of shares to sell. We also need to discuss the augmented reality AR aspect. Apple just released the Vision Pro and Meta is pushing the Quest. The expectation is that Snap is too small to compete in hardware. The reality, Snap's Spectacles, the new AR version, are arguably the most impressive standalone consumer AR implementation, even if they aren't mass-market ready yet. But Snap isn't trying to win the hardware war. They are winning the software war. Their Lens Studio is the industry standard. When you use Fidelity ETFs to buy a basket of metaverse stocks, you are usually buying hardware manufacturers, but Snap is the one with the developer ecosystem that actually creates the 3D assets people use every day. Over 300 million people engage with AR on Snapchat daily. That is a staggering number. They are effectively the operating system for AR, regardless of who builds the headset. Let's compare this to the financial health of the company. A few years ago, Snap was burning cash like it was going out of style. Today, the cash flow picture is different. They have reduced headcount, cut unsuccessful projects like the Pixie drone, and focused on the core app. If you use online investing tools to screen for free cash flow growth, Snap is starting to pop up on those screens. They generated positive free cash flow in the recent quarter. This changes the thesis from speculative growth to deep value. You aren't paying for a dream anymore, you are paying for a business that is self-sustaining. This is a crucial distinction for those using Schwab Intelligent Portfolios or similar robo-advisors that filter out companies with high bankruptcy risk. Snap has moved out of the danger zone of insolvency, yet the stock price hasn't acknowledged it. Now look at the technicals on the chart. We are trading below the 200-day moving average, which is technically bearish. However, the RSI on the weekly chart is showing a bullish divergence. This means that while the price made a lower low recently, the momentum indicator made a higher low. Technicians who use the Interactive Brokers platform or Fidelity Trading platform love these setups. It indicates that the bearish momentum is fading. We are also seeing a compression in the Bollinger Bands. For those who don't know, this usually precedes a violent move. Given the accumulation we discussed earlier, the probability of that move being to the upside is statistically higher. There is also the acquisition target angle. At a market cap of roughly $13 to $14 billion, Snap is bite-sized for a major tech player. Not Meta, antitrust would block it, but what about Amazon or Microsoft? Both need a social entry point. While Evan Spiegel, CEO, controls the voting shares and has shown no interest in selling, everyone has a price. As the stock languishes, the pressure from the board and institutional